Breakouts are situations where price breaks past a fib level and surges to previous or new record highs with large price movements and high volume. These are very risky trades because they are very large and sudden movements compared to reversals. It is also much more difficult to plan entries and profit targets, as well as manage risk. For these reasons, it is strongly recommended to not trade breakouts. This section is more of a chance to highlight drastic price behavior when key fib levels are reached. In this example, price returns to previous resistance at the 0.5 fib level, where a recent reversal had occurred. Price begins to stall just before the 0.5 fib level before breaking out to approach previous record highs with a large and steep price movement and a spike in volume. Price breaks through the trend line of the confirmation triangle in addition to the 0.5 fib level. Later, the exact same features are exhibited, except this time price breaks out to previous historic all-time highs, where it stalls and congests, before making a smaller breakout to establish new historic high prices. We can also see features discussed previously. For example, a trading range below resistance at the 0.618 fib level. This area could have been traded like a trading range, and a continuation trade in the firmly established uptrend. Additionally, there is a reversal off the 0.236 level at the start of 2018 after a sharp price drop in a relatively short period of time. This also presented another trading opportunity. There is also the phenomenon where price begins to stall and eventually reverse after 2 to 3 fib levels. This occurs even with a strong surge during a breakout. A profit target 2 fib levels above the breakout fib level is once again the safer approach. The chart also demonstrates why it is so risky and difficult to manage risk with an L or M entry. You can see price will break out at or slightly above resistance. Since the entry is so close to resistance, a stop is very difficult to place, even when referencing past reversals on the same fib level. It is easy to look at breakouts in past examples like these. It is much more stressful and uncertain when trades are done live. Imagine you're trading this example. Price moves above the 0.236 level, then reverses below a past reversal area from July 2015 before returning back above the 0.236 level, where it stalls before surging higher. This would not exactly be the most comfortable experience, having to wait a few days for a trade that has a higher chance of failing. Sometimes it is recommended to make the late L entry after price has cleared resistance. However, as you can see in the previous two examples, this is still an uncertain and stressful approach, especially if price stalls. If price doesn't stall, then even a limit order will likely be too slow to enter when price surges up so fast. It is unlikely your buy order can be filled slightly above resistance, especially for stocks because they can gap up significantly overnight. The other alternative to mitigate these issues is to trade the aftermath of the breakout and not the breakout itself. This is essentially like a continuation trade. Here, a price dip is an entry opportunity in a larger uptrend that began at an initial breakout at the 0.236 level. This chart highlights potential entry points when price makes slight pullbacks in the upward trend that is expected to continue. Trading the aftermath of breakouts is only to be done if it is believed price will continue a larger, longer-term uptrend, and price is only expected to pull back with small dips. This still carries a risk, as can be seen with the first price dip, which needed a much larger stop in order to avoid being stopped out. The next two trades between April and June were more safe, after the 0.618 level began to establish itself as a firm support. While this strategy has less risk than directly trading the point where price breaks through resistance, there are still major drawbacks. After a breakout has occurred, a pullback is much less likely to have price drop back down and reverse exactly in the same area where the breakout started. It can be difficult to interpret whether price is just making minor dips within a larger uptrend, or if price is ready to make a major reversal back down after an over-optimistic reaction that sees price too steeply upward. Remember, a breakout often returns price back to previous major highs, all-time historic highs, or new historic all-time highs. All three of these situations increases the chance price will have a major reversal rather than a minor price dip. Here is an example of a breakout where a stock gaps up overnight. Price gaps up and the minor price dips that follow are still at very high prices. They don't even line up nicely with the 0.786 fib level, let alone the breakout point and gap up levels at the 0.382 and 0.618 fib levels. Here is a similar situation to the previous chart, except here price gaps up and does pull back to nicely line up with fib levels, in this case the 0.236 fib level. However, price is still very high and doesn't return close to the fib levels where the breakout and gap up occurred, in this case the 0.382 and 0.5 fib levels. This scenario is far less common than the previous example. Price rarely lines up cleanly with fib levels after a strong breakout, especially if it is a stock that gapped up overnight. It is even more rare to have price return back to the exact fib levels where price broke out and gapped up. On this chart, price reaches previous resistance when returning to all-time high prices to form a double top. Instead of reversing, the ideal breakout occurs, and price rockets to new record highs. However, trading like this in the short term is not always safe. This, like most breakouts, was driven by a news catalyst, which in this case was an earnings report. These events can go either way, basically a coin flip. This chart is a situation where price did not break out higher after returning to resistance from a double top. Although price eventually continued to reach new record highs, this short-term trade was an absolute failure. Price fell far below any entry point that would have been near resistance at the 0 fib level at all-time highs. And this is why breakouts are not recommended in most situations, especially for the less experienced. The movements, while spectacular, are extremely rapid and difficult to plan for. This makes for lower chances of entering and exiting one successfully.